So we will focus on standard costing and variance analysis theory part in the first class. Okay, and also we will take up material cost variance. Since you already have learned some basics about it, we will take more than one material, mix material problems. So what is standard costing? See what happens in big manufacturing concerns where they are manufacturing standard products. For example, take bucket, soap. So every time they will not customize. It's like a regular production. So in such cases, every time to prepare the cost sheet is a cumbersome activity. So instead what they will do, they will establish standards. With that, what happens? What is the benefit they get? With this predetermined rate, so they find out what is the standard costs. So and standard quantity in case of material. So there are different standards they can set, not only for material, labor, overhead, then sales value, sales quantity, sales margin. All of this you can set standard. So these are predetermined estimates, and this is whatever normal operation condition they are utilizing plus some scientific and engineering calculation, both they will apply and come at a standard value. Whenever the production is happening, they compare the actual with the standard, and if there is any difference, so this difference is called as variance. So they do variance analysis. So variance can be positive or negative. If it is positive, so they will understand what went well, and using that they will either improve the standard or they will revise the standard rates. If it is adverse, then they will see why it is happening. So it is two way. One is it is an easy process. Once it is set, setting is not an easy process. So once it is set, doing the variance analysis is an easy process and a faster process. Second is they will find out the root cause. Okay. So what are the advantages of standard costing? First one is benchmarking. So this is nothing but setting the standard rates. Then cost control. So if there are any adverse variances, they can control, they can identify why it is happening, and they can take appropriate actions. It simplifies record keeping. So like I told, every time cost sheet or records are not required to be prepared for every transaction. So it simplifies the record keeping. Then performance evaluation. Now with the variance, they can identify which department is accountable or responsible. So the performance of that department can be evaluated with the proper data. Then motivation and continuous improvement. So continuous improvement is when there is an adverse variance, they do root cause analysis, identify the cause, fix it. And if there are positive variances, so it will motivate those departments that they are meeting their targets, their budgets, it motivates them. So these are the advantages of standard costing. There are certain disadvantages also. What are they? First, setting standard is not an easy job. It takes a lot of time. It takes time to study, apply. Then they see, okay, this is working. And it is also costly. Costly in terms of effort the management puts, effort the controller or the planning team puts. Then there is a risk of unrealistic target. So based on probably 3 years data, normal production, they may set a standard. But what if that 3-year data was very good? So going forward, that becomes the benchmark. But going forward, it also can become unrealistic to achieve. So that risk is there. Then it ignores qualitative factor. So standard costing and variance analysis is totally quantitative. That means everything is calculated. There is no subjective approach to standard costing. But in business, there are sometimes qualitative aspects also are required. So in the standard costing, that is ignored. Then potential for suboptimal decision. That means if my standards are not optimal, I will always look up to my standards only. I don't look at market, what the market is doing or what my competitor is doing. I just take my standard as my target and I work towards it. So it may result in suboptimal. Suboptimal means it is not the best. It's like average or below average. Then implementation complexity. Like it takes time to set the standard, calculate standard values. It also takes time to implement. How will I measure the actual quantity? How will I measure actual hours? Where I will record this? How it flows to my material control system? So this IT support will be required. So it takes time for implementation. Okay. Then how standards are set? So standard is derived from your past data, historical data. Then also there are some engineering and scientific calculation which are involved. So engineering studies, then there are supplier codes and market condition. So historical data comes from your direct material, direct labor, overhead, which are internal. Okay. And a lot of departments will give their inputs, like production will give their inputs, HR will give data with respect to labor hours and labor rates. Then purchase department will give data about material prices, supplier quotation. Production will give data about overheads, how many hours are consumed, how much material is getting consumed. So these data are all analyzed, and periodically this analysis happens and the standards are revised. Then the standards are sometimes classified into different types of standard. Example is ideal standard, like this is the best, everything happens 100% what my values look like, that is ideal situation. Then next is attainable standards. Given some inefficiencies in the system, it's like some idle time, what is my attainable standard? This is the regular thing. So this is what will be used for our standard costing and variance analysis. So you may get a question called what is the objective of standard costing? So remember this acronym YCRD. Y is yardstick, yardstick or a benchmark. Then C, controlling, to control the cost. How do I control the cost? I do variance analysis, and depending on adverse or favorable, I do the course correction. Facilitating responsibility. If there is an adverse, who is responsible for that? I catch hold of that department. I will ask for root cause analysis, then I'll fix it. Then D is for decision making. So now with standard costing, I know standard cost of my product. So I can do the proper pricing decisions. So remember YCRD. Essential step, this we have already covered, so I'll skip it. Then what is the difference between standard and estimated cost? Estimated or forecasted, all these are non-scientific. They just rely on the historical data. But in the standard costing, we take some calculation, we apply engineering decisions, then we apply supplier quotation, market condition. So all these are involved in standard cost, but not in estimation. Then types of standard. So first one, whatever I told, ideal standard. So this is based on the perfect condition. Next also I have explained attainable or expected standard. Some inefficiency is there in the system. Considering all that on a day-to-day basis, what I can achieve. So that is the attainable standard. Then you have basic standard. This is set for an indefinite period. Okay, this is like used as a base. So below this, I should not go. So this is my base. Above this, depending on different variations, my standards also will vary. So sometimes raw material prices may fluctuate, but my rent is not fluctuating because it is my own premises. So basic standard will consist of some thing which act as a base for long-term analysis. Then normal standard, this is the average performance over 3 or 5 years, typically 3 years. So these are the normal standard. Okay, then what are the principles of setting the standard? All this I have already explained. Analyze technical and operational factors, then set standard for each element. So whatever variance analysis you are going to do in this chapter, all those elements, material, labor, variable overhead, fixed overhead, sales value, sales margin, on all this you set a standard. Okay, then you will involve all departments, whichever is involved in setting the standard. Production, purchase, HR, engineering, then also sales will be part of this. Then distinguish between variable and fixed overhead for more accurate standard. Review and revise standard periodically. So you may get a question also, the difference between standard costing and budgetary control. The object, so remember this heading, OSAA. What is the objective, what is the scope, what is the application, and what approach I take. Objective of standard costing is cost control and variance analysis. Okay, this is only related to these production aspects, production and sales aspects. Whereas budgetary control is for the overall business, because in budget you have all types of budgets. Whereas in standard costing, it is related to these material, labor, overhead, and sales. Scope, it is specific to production cost. Budgetary control covers all functions and all departments. For example, logistics, it is not covered in standard costing, but in budgetary control, they will cover. Application of standard costing, I will set standard unit costs or standard unit selling prices. Whereas budgetary control is to arrive at the total expenditure for a particular period, then work backwards. So that is the objective of budgetary control. Approach of standard costing is it focuses on manufacturing and efficiency. Budgetary control is more on planning and achieving the targets. Okay. Then next, what is variance analysis and its role? I have briefly explained. This is what we are going to do in standard costing actually. You identify what is the standard value, what is the actual value, look at the difference, that is your variance. If it is positive or negative, depending on that, we take further actions. And also it assigns responsibility of particular department. The next important topic here is management by exception. So this term you have to understand. Why I am doing standard costing? There will be certain minor variances during my production. So if it is within some values, it is okay. Management need not bother too much about them. But if it exceeds by a margin, then management will come into the review. So this phenomenon is called as management by exception. Means they will not look at day-to-day variances. Their time is valuable. They will only review exceptional issues. So this is the definition of management by exception.